there's an invisible tax on new investors. It's not levied by the government, but by human nature itself. It's a tax paid in the form of simple, avoidable mistakes. These mistakes, born from emotion and a lack of a clear strategy, can silently drain tens, or even hundreds of thousands of dollars from your portfolio over a lifetime. You can have the best intentions, you can pick the right investments, but if you fall victim to these common pitfalls, it's like trying to fill a bucket with a giant hole in the bottom. Today, we are plugging those holes. This video is your definitive guide to the 5 most common and costly investing mistakes beginners make, and more importantly, the simple, actionable strategies to avoid them. Understanding these pitfalls is just as important as knowing what to buy. This isn't just a list, it's a strategic shield for your financial future. By the end of this video, you will be equipped to navigate the market with discipline and confidence, saving yourself from the invisible tax. Let's get started. The first and most fundamental mistake is starting your journey without a destination. It's investing money just for the sake of investing. Without a clear why, your investment strategy has no anchor. Are you investing for retirement in 40 years? A house down payment in 7 years? A child's education in 15, each of these goals requires a completely different strategy, a different timeline, and a different tolerance for risk. If your goal is short-term, like a house down payment in 3 years, putting that money into the volatile stock market is extremely risky. A market downturn could wipe out a significant portion of your savings right when you need it. For short-term goals, safer options like a high-yield savings account or I-bonds are far more appropriate. If your goal is long-term, like retirement in 30 years, being too conservative and keeping your money in cash is just as big a mistake. Inflation will decimate its value. A long-time horizon is your license to take on the calculated risk of the stock market to achieve the growth you need. The fix: before you invest a single dollar, write down your specific, time-bound financial goals. For each goal, define its timeline. This simple act will dictate your entire strategy and prevent you from taking on too much, or too little, risk. The fix: before you invest a single dollar, write down your specific, time-bound financial goals. For each goal, define its timeline. This simple act will dictate your entire strategy and prevent you from taking on too much, or too little, risk. The second mistake is one of the most tempting. It's the belief that you can outsmart everyone else by predicting the market's next move, selling at the top and buying back in at the bottom. This is called market timing, and the data is clear: it is a fool's errand. A study by Bank of America looked at market returns from 1930 to 2020. It found that if an investor stayed fully invested in the S&P 500, they would have seen a certain massive return. But if they missed just the 10 best trading days of each decade, their total return would be slashed by an astronomical amount. The cost of being on the sidelines for just a handful of the best days is devastating. The market's best days often happen in close proximity to its worst days, during periods of high volatility. Trying to jump in and out means you're just as likely to miss the explosive recovery as you are to avoid the crash. No one, not even the most brilliant investors, can consistently predict short-term market movements. It's a game of luck, not skill. The fix: the solution is not timing the market, but time in the market. Implement a strategy called dollar cost averaging. This means you invest a fixed amount of money at regular intervals, say $100 every week, no matter what the market is doing. When the market is high, your $100 buys fewer shares. When the market is low, your $100 buys more shares. It automates the process of buying low and removes emotion from the equation. This mistake is the evil twin of market timing. It's letting your primal fear take over during a market downturn and selling everything in a panic. A market correction, a drop of 10% or more, is a normal, healthy, and recurring event. On average, they happen about once every 2 years. It's not a matter of if, but when. When this happens, the financial news will be screaming about a crash. Your gut will tell you to sell to stop the bleeding. This is the absolute worst thing you can do. Selling after the market has already dropped doesn't protect you. It simply turns a temporary, on-paper loss into a permanent, real-world loss of capital. Remember, a market downturn is a temporary sale. You are getting the chance to buy shares of the world's greatest companies at a discount. Panic selling is like running out of a supermarket because your favorite cereal just went on sale. The fix: have a plan before the storm hits. Write down on a piece of paper, when the market drops, I will not sell. I will stick to my automated investment plan. Also, avoid checking your portfolio every day. It's like weighing yourself every hour when you're on a diet. It will drive you crazy. Zoom out and focus on the long-term trend. Our last two mistakes are the silent killers of wealth. Mistake number 4 is lack of diversification, or putting all your eggs in one basket. It's easy to fall in love with one exciting company, a hot tech stock or a crypto coin, and invest all your money in it. This is not investing, it's concentrated speculation. Even the greatest companies can fall on hard times. If your entire net worth is tied to one company's fate, you are exposed to catastrophic risk. The fix: diversify. As a beginner, the easiest way to do this is to buy a low-cost, broad-market index fund ETF, like one that tracks the S&P 500. With one purchase, you own a small piece of 500 companies. Mistake number 5 is ignoring fees. This is the most insidious mistake of all. Small fees, often listed as an expense ratio, seem harmless. 0.5%. 1%, what's the big deal? The big deal is compounding. A 1% fee doesn't just cost you 1% of your money each year. It costs you 1% of your money, plus all the future growth that money would have generated for the rest of your life. Let's look at the numbers. A $10,000 investment growing at 10% for 40 years with a low 0.05% fee grows to over $420,000. That same investment with a 1% fee grows to only about $300,000. That tiny fee cost you $120,000. The fix: make low costs a religion. When choosing an ETF or mutual fund, the expense ratio should be one of your primary decision points. Aim for funds with expense ratios below 0.10%, and ideally, below 0.05%. Uplifting, empowering music fades back in. We've just built your strategic shield. You now know the 5 major pitfalls that derail new investors, and you have the simple, actionable fixes for each one. Investing is a long-term game. Success is often less about making brilliant moves and more about consistently avoiding stupid ones. You are now equipped to avoid the stupid moves. Your action item is to create your investment policy statement. It's a simple document with 3 sentences. My goal is, your goal. My strategy is to invest consistently in low-cost, diversified funds. I will not panic sell during a downturn. If this guide has helped you build your strategic shield, please hit that like button. It's the best way to help this video protect more investors from these costly mistakes. And to continue building your financial fortress, make sure you are subscribed and have the notification bell on. Finally, in the comments below, tell me which of these 5 mistakes you were most afraid of making. Acknowledging it is the first step to avoiding it. Thank you for your time. Invest smart, invest safe.